the momentum in the precious metals markets lends credence to the precious metals narrative. And the generalist investor comes into the precious metal space, perhaps because of silver's lower unit cost, making it more affordable, or perhaps because of its reputation for upside volatility, or perhaps both. The generalist investor, particularly the speculator, becomes attracted to silver. And the leadership in the market changes from gold to silver. Steve, when that happens, you won't need Rick Rule to tell you what's happening. It will be very dramatic. It will be very, very, very apparent.
Gold has delivered a stellar performance over the past year, with prices surging nearly 40%, rising from around $1,850 to over $3,400 per ounce. This impressive increase has rewarded investors with substantial profits and reaffirmed gold's role as a safe haven amidst economic and geopolitical uncertainty. According to veteran investor Rick Rule, gold often leads the charge in turbulent times, as it reflects global distrust in fiat currencies and central bank policies. With inflation concerns, political instability, and interest rate worries looming, gold has remained firmly in the spotlight. Meanwhile, silver has lagged behind, rising just 15% during the same period. While this may initially seem like underperformance, history suggests that silver plays catch-up and often delivers more explosive returns once momentum builds. Silver's rally gained serious traction in early 2024, with prices climbing from $23 to over $34 an ounce. Yet, silver still appears relatively undervalued when compared to gold, especially when viewed through the lens of the gold-to-silver ratio. Currently hovering above 100, this ratio indicates that it takes more than 100 ounces of silver to buy a single ounce of gold, far above the historical average of around 70. Rick Rule notes that such extremes in the ratio often signal critical turning points, with silver historically outperforming once the ratio normalizes. Silver would need to rise significantly for the ratio to revert to historical levels, or gold would need to correct. With gold already near record highs, many see a compelling case for silver to continue climbing. Rule also challenges the emphasis on silver's industrial uses as the primary driver of its price, arguing that investor demand has played a more significant role in major price movements. Instead of focusing solely on silver's industrial utility, Rule advises investors to consider the dynamics of investor sentiment and speculative demand, which have historically been the true catalysts behind silver's dramatic price fluctuations. Now, we present the clips from Rick's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I think the gold-silver ratio is a factoid. I think it's important only because the market thinks it's important. Think this through. People say that the ratio should be 16 to 1, which reflects the relative abundance or scarcity of both commodities in the Earth's surface, relative to 100 to 1, which is the price differential. But why should price be a function necessarily of supply or scarcity when it doesn't consider utility and it doesn't consider cost of production? With silver, as an example, about 18% of the world's supply of silver comes from silver mines. The rest comes as a byproduct of mining other metals or as a consequence of recycling. What that means is that the production cost around silver is a minor impact, a minor part of the supply demand equation. Look too at the massive above ground holdings of silver in private hands. Most of the gold that's held publicly is held in public hands, which is to say in government hands, but silver is controlled in private hands, which makes it much more difficult to measure. In my experience, industrial supply and demand in silver has been interesting, but the quantum moves that we've seen in the silver market, the moves from $4 to $50, or in the 70s from $1.20 to $50, have come as a consequence of overwhelming investment demand. That's happened 3 times in my life. I've seen better than tenfold moves in silver bullion 3 times in my life, and none of them accompanied increases in industrial materials markets. My experience has been that precious metals bull markets are led by gold. Eventually, and we're seeing that right now, leadership changes from the bullion to the highest quality gold stocks. Later, leadership changes to the mid-tier gold stocks. When the momentum in the precious metals markets lends credence to the precious metals narrative, and the generalist investor comes into the precious metal space, perhaps because of silver's lower unit cost, making it more affordable, or perhaps because of its reputation for upside volatility, or perhaps both, the generalist investor, particularly the speculator, becomes attracted to silver. And the leadership in the market changes from gold to silver. Steve, when that happens, you won't need Rick Rule to tell you what's happening. It will be very dramatic. It will be very, very, very apparent. But I'd pay less attention to the gold silver ratio. And I'd even pay less attention to the utility generated by silver in the industrial market. And I would pay much more attention to the traditional dynamics around investor and speculative demand in precious metals markets and the history of the price action in those markets. Well, I would say that from the tier one boot camp, 100 million ounces of silver probably puts you in strong tier two.
Okay.
Understand that we want minimally $10 million in situ recoverable reserves and resources, but we would prefer $20 billion in situ recoverable reserves and resources. Now, big silver deposits, well, in fact, economic silver deposits are extremely rare. So speculators can be a little more generous in the silver side. We've talked before, you'll remember the silver boot camp, where I think we were able to establish that the market capitalization of legitimate silver juniors is so small that when the generalist investor is tempted down into the silver space, there isn't sufficient market cap to handle the money. These are the most volatile financial instruments in the resource business. If I take myself back to the decade of the 70s, I remember the shares of Coeur d'Alene Mines going from 10 cents to $65. That's not a typo. I was too young, too poor, and too dumb to take advantage of that. But I also remember a wonderful small silver bull market that we had at the beginning of the 1990s. I remember Pan American Silver going from 50 cents, where we had the good fortune to underwrite them, to $45 in 6 or 7 short years. I remember Silver Standard Resources under Bob Quartermain's stewardship. The point of all this is that Cerro de Pasco is part of a fairly small club of legitimate silver juniors with reserves and resources exceeding 100 million ounces, where when the generalist investor comes down into the precious metal space, I should say if, not when, if the generalist investor comes down to the precious metals space, these things can exhibit almost unbelievable upside. The people who buy these things in good markets are not the people who attend the Rule classroom. These are people where if the silver price goes from $30 to $90 or $100, they believe that trend is going to continue on indefinitely. They are people who buy narrative, not fact. You need to be in these markets before they get there. They need to be your exit strategy.
The world economy has become increasingly unpredictable in 2025 as significant shifts in global economic dynamics continue to unfold. The long-standing era of globalization is being replaced by a rise in nationalism and the formation of regional trading blocs. These changes are particularly evident in the protectionist policies now being pursued under the new Trump administration, which has focused on reducing reliance on international trade agreements and increasing tariffs on foreign goods. This transition transforms how nations approach trade and economic cooperation, creating a more fragmented global market. As a result, the business environment has become more volatile, and countries prioritize their economic interests over global partnerships. In the face of this uncertainty, commodities such as gold have seen substantial price increases, with many investors turning to them as a safe haven amidst the turmoil. This surge in gold demand reflects the growing anxiety surrounding the future of fiat currencies, especially the US dollar. Rick Rule predicts that the purchasing power of fiat currencies, particularly the US dollar, is on a clear trajectory of decline, with a staggering forecast that the dollar could lose up to 75% of its value over the next decade. This anticipated erosion in the dollar's purchasing power is expected to drive a continued rise in the price of gold as investors seek assets that can preserve wealth and act as a hedge against inflation. Historically, gold has proven to be a reliable store of value during periods of economic instability and currency devaluation. Rules analysis suggests that the increasing demand for gold, driven by a weakening dollar, will likely continue as global economic uncertainty intensifies.
We had a situation in the 1970s that was a very odd recession. It was stagflation, which is to say you had an economic slowdown that was accompanied by inflation too. Normally, recessions are caused by higher interest rates. In this circumstance, the recession was both a cause and an effect of the higher interest rates. That was a really interesting circumstance that I'm afraid we're doomed to repeat. The part of that assertion that I think is particularly relevant to today is that in the decade of the 70s, the absolute purchasing power of the US dollar, which is to say its performance against itself as opposed to some other currency, was that the dollar lost 75% of its purchasing power. It's not coincidental that in that circumstance, the gold price went up. The gold price held or more than held its own purchasing power. If we look back at the decade of the 70s, and we put on one side the 75% decline in purchasing power, and we put on the other side the 30-fold increase in the gold price, I think we can roughly dissect that. Not exactly. The move from $35 an ounce to say $100 an ounce was mostly a function, I think, of the end of price controls on gold, which is to say it was a coiled spring. When in this country it was at $35 an ounce, there was a gray market for gold internationally between 42 and 45. When the price cap came off in the United States and American demand met world demand, the price went from 35 to 100. The price began to, it is arguable, overshoot in 1974 into early 1975 when the gold price went from $100 an ounce to $200 an ounce. At that point in time, there was broad spread concern about inflation. Everybody wore these whip inflation now badges. Nobody did anything about it, but they wore badges. But Congress did something about it. They raised the interest rate. Well, the market raised the interest rate, and Congress and the Fed followed through. Fairly dramatic increase in the interest rate. That did two things. Well, three things, really. It tanked the bond market. It already hurt equities markets, and it obliterated the gold market. In 1975, the gold price declined from $200 an ounce, to $100 an ounce. Towards the end of 1975, looking at the bond market, looking at the housing market, looking at the equities market, the U.S. government blinked twice and reduced the interest rate. When that happened, investors understood what was happening. The game was on. And the gold price went from $100 an ounce to $850 an ounce in 6 short years. My suspicion is that past is prologue. Now, remember that at $850 an ounce, what you had was a circumstance where gold was overbought. Gold went from being unloved to being the only game in town. So I would suggest to you in the context of today's discussion that the real price of gold in the decade of the 1970s, before the overshoots, probably ran fourfold. In other words, the US dollar declined by 75%, and the nominal price of gold, probably mirrored that fall, probably went up fourfold. The move from, say, 400, 450 to 850, I think probably had to do with piling on. I think it had to do with people coming into a trade that had already established itself. We know that mean reversion is usually accompanied by overshoots. And my suspicion is that happened in the 1970s, and my suspicion is it may happen again. I believe in the period 2025 to 2035, that is to say the next 10 years, the US dollar probably loses 75% of its absolute purchasing power. Not its purchasing power relative to the Swiss franc or the euro or the Canadian dollar or the renminbi. I'm not talking about that. I'm saying for US dollar denominated spending, that the US dollar loses 75% of its purchasing power. And my belief is that it is likely, not certain, that gold mirrors that, which is to say that gold goes up in commensurate fashion with the purchasing power of the US dollar going down. Is this a trade that somebody should put their whole net worth in? Of course not. This is a contingency worth insuring. That's what it is.
Silver's recent consolidation between $32 and $33 reflects a delicate balance of industrial demand and investment interest, creating a stable market yet poised for significant movement. Analysts forecast that a breakout past $35 could trigger algorithmic trading and spark a rush of retail investors. Historically, silver has shown a propensity for rapid price movements, with notable examples like the 2020 rally, where prices surged from $12 to $30 in a short time frame. This pattern suggests substantial upside potential, particularly if industrial shortages materialize. Meanwhile, gold attracts investors seeking safe havens in times of economic uncertainty. With the US dollar facing potential decline and inflationary pressures rising, gold has surged to new highs as it mirrors the challenges faced by fiat currencies. If global economic turmoil persists and industrial demand for silver remains strong, both metals could experience continued upward pressure, with silver potentially seeing significant growth fueled by industrial needs and investment speculation. Share your thoughts on Rick's prediction on gold and silver prices in the comment section below. If you find this video informative, don't forget to support and turn on notifications to stay informed about our latest videos. See you in the next video. Thanks for watching.